Welcome, everybody, to another edition of Think with a Drink. This is the weekly webinar show brought to you by the IRAs Foundation for Financial Education. Tonight's episode is 7 IRA mistakes that could cost you a fortune.
Oof.
Okay, so there's probably more than 7, but we're going with 7. This is easier for us in the format that we have to try to do, but there's probably more. Some of them may seem fairly obvious. Some of them you may have heard of. Some of them you may not have realized that, wait a minute, this is something that is actually could trip me up or cost you, or more importantly, cost your beneficiaries a lot of monny.
Plus, it's a nice even number.
Yeah. Well, no, it's a lucky number.
Oh, lucky number. Okay.
You always use odd numbers, right? That's why the Steve Jobs with the whole 3 thing. You never use even numbers. I don't know why that is, but that's how it is.
Okay.
Anyway. Now, next slide, real quick on us, who we are. My name is Tom Alessi. I am the president of the IRAs Foundation for Financial Education. I have been in financial services for, going in my 25th year right now. I am a certified fiduciary. That just means that anytime I'm giving any guidance or advice to anybody, I am always acting in their best interest. I want to bring my vice president, Craig, if you can introduce yourself.
Sure. So I'm Craig Richardson. I'm the vice president of the IRAs Foundation. I've been in financial services a little over 20 years now, and I specialize in working with families and individuals to help them to find their financial goals and have a better relationship with their money.
And real quick on the IRAs Foundation. So we're a nonprofit. We're located here in Newton, Massachusetts. You can find us on the web. It's www.aresfoundation.org. The mission behind IRAs is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you're in a relationship with your money. And just like every other personal relationship that you have, there are behaviors, triggers, things that cause us to act, well, as Craig and I like to say, irrationally when it comes to dealing with our money and our finances. That's all myself, Craig, the rest of our team tries to do is help everyone take a step back, take a little bit of a breath, take a little bit of that emotion out of the equation, and just sort of think about money in a different way. So check us out on the web, find us. We're happy to try to help you out. Next slide. All right, so one of the things that we try to do for everyone and have a little fun with this is take some of these concepts, some of these ideas, some of this intricacies, is that the right word?
That's
very good. It is a lot there, right? Break it down, make it a little bit easier to comprehend, a little bit easier to digest, take a lot of the language, a lot of the jargon that's out there out of the equation. And we can't think of a better way to do that than as if we have something to sip on while we're doing that. For this one, this is what happens when I go deep into my beer closet.
Okay.
This is Sierra Nevada's Celebration IPA. So the celebration is this is a Christmas IPA. This is meant more for
which Christmas?
Yeah. Unfortunately, that's what happens. Like I said, sometimes when I go digging deep and to see what's left in the beer closet there and go through. But it has some of those spices that go along with the IPAs as part of that. But so to everybody, skål.
Skål. I love the can. Family owned, operated, and argued over. I like that.
Yes. All right. We're going to break these down mistake by mistake, okay? So mistake number 1 is not understanding when you need to begin taking, and these are called, Craig, required minimum distributions.
Yes, or RMDs.
RMDs, right? Not WMDs, RMDs. These are required minimum distributions. What the IRS says is that everybody who has put money into a pre-tax account, i.e. your retirement plan at work, 401k, 403b, an IRA, anything that you've taken a tax deduction for, at some point, Uncle Sam, he's going to have his hand out.
Wants his money back.
He wants his money back. He wants to get his tax bite out of that money. And there comes a certain point out into the future where you have to take that. Now, for a long period of time, that number was 70 and a half years age.
Right. It was ingrained in people's head. Everybody knew that's what it was.
Yeah.
Right.
And so when you ask, somebody says, oh, don't I have to start taking this at 70 and a half? Well, so it changed, right? So if you can take the next slide, should pop up. You know, it's so What did I do with that one?
I don't
That's
know. You
weird.
missed a beat on it. That's okay. We can explain it though. We don't need the slide.
I know it comes up, so we're going to just wing it in terms of this part. So anyway, what happened was you had first Secure Act,
Right.
which is just, this is terminology as we go through this, but the Secure Act passed and said we're going to raise the minimum of the required age
Right.
from 70 and a half to 72,
And that was federal legislation that came out in what, 2020?
2020.
Yes.
Then they decided to add Secure Act 2.0 on top of that,
Wow.
which now made it 72 to 73. However,
Like John Wick 2.
yeah, not John Wick 4, John Wick 2. Within the next basic, from here, 8 years. So by 2032, the required minimum age will go to 75.
Wow.
75.
Wow.
So, here's the situation with Secure Act 2.0. One of the nice things that it did, that tells you there that, the thing on the screen had said what happens if you don't take your required minimum distribution.
Right.
Before it used to be a penalty. I think if you go to the next slide, it'll probably pop that up. Oh, there it is. It drops down. See? So before the legislation and the IRS still says if you don't take your required minimum distribution in the time necessary, i.e. the age that you were supposed to take it, then you can be charged a tax, a penalty
Yep.
of 50% of whatever you were supposed to take.
So if you were supposed to take $5,000, it'd be $2,500 on top of the $5,000.
2,500 they could charge. Now here's the whole thing with Secure Act 2.0. They realized that, Secure Act said we're going after everybody, right?
Right.
We're going after Nana who forgot, But now in this case, 2.0 says, well, you know what? If Nana forgot, we'll
skate it.
Yeah, we're okay. We'll come back to Nana at some point and ask her for the money.
It's not good for votes to penalize the elderly.
Yes. As we get to later on in the screen, the other is that you really don't want to penalize anybody who can vote, but that's a different story in terms of going through it. But so the idea there is you still should do it. You shouldn't get yourself into the situation of not
Right.
taking it. The IRS, the Department of Labor, supposedly aren't going to be actively trying to go after
But
everybody.
why put yourself in that position? Right.
Why put your money in that situation? So the idea again, just so we're clear, as of today, this is 2024, you have to start taking required minimum distributions once you achieve age 73. Sometime in that year, you've got to take that required minimum distribution. For those who have time, 10, 15 years out to there, it won't be until you turn 75. Now, here's one of the little, let's call it keys in all of this with
Yeah.
it. The fun part of that, what the IRS has done and what the government is doing is they're raising how much you have to take out when they do that. Right. So I maybe only had to take 3.5 when I was 70 years old.
Right.
Now I got to take like 5.25 out.
Right, because a lot of people think it's a straight calculation. I got to take out this percentage every single year. It's really based on life expectancy, right? So based on how many years your average those tables they're using are,
Right.
and how many years you have left. So you actually have to take out incrementally a little bit every year more, right? So actually it starts getting past that 4 or 5% threshold that we talked
Correct. The government wants their money, ultimately, is what this comes down to. Right. Next slide. Hey, there's. See, I knew it was here. See, that's what it is. This is what we just went through. You're right. So
just
again,
made it just as confusing as the question was in the first place.
I know. Yes.
We just want to make sure everybody's paying attention.
I just had it backwards in my head. That's
okay.
all, it's a lot to keep in there.
That's right. That's right.
And go through. Okay, thank you for that. Mistake number 2, right? This is, taking your required minimum distribution from the wrong account. So here's the way this works. Required minimum distribution, again, anything that's pre-tax, right? So if you go to the next slide, it sort of cleans this out a little, right? So what this shows is that, say, I've got 3 different IRAs.
Yes.
IRA being individual retirement account. These are accounts I either set up for myself or maybe I took money from an old account and rolled it into it.
So it's a retirement account I own. It's not with my employer.
Not with your employer anymore. It's individual retirement account, okay? So in the case of this, what you can do is you can say, I'm going to take from each one of these, which is what usually happens for most people. They're going to just, at the end of the year, figure out how much is in there, and I've got to take this percentage out of each of these accounts.
Okay.
That's one way to do it. Another way to do it is you can say, you know what, I have something that's either in a guaranteed position, i.e. getting an interest rate that's much higher than what's prevalent. This was 10 years ago when there was no interest, and you had people who were in accounts getting 5-6%. Why would you touch that?
Right, and it may be right now too if you got it in a certain account.
In certain accounts. What you can do when you have all your money in different IRAs is say, you know what, I can just draw from one. Again, I've got to have the total amount, and let's use round numbers so nobody hurts themselves. Let's say it was 3 accounts with $100,000 in each, that's $300,000. I can take whatever my required distribution for the total of the 3 from position number 1 and leave 2 and 3 alone.
Correct.
Right? Which is fine if you're doing it that way. So here's the thing, next slide. However, if I've got money, as Craig mentioned, sitting in an old retirement account, i.e. at my old employer, whether that's in a 401k or as the screen shows you, in a 403b arrangement, 403b just being a retirement plan for nonprofits, what has to happen is I can't commingle the distribution anymore. I can take money from the IRA accounts, commingle those, but the money that's in the retirement accounts, whether that's 401k, 403b, or how many I might have, because we sit down with people sometimes who've got 4, 5, 6 of these things.
Oh, sure, from old jobs, whatever, right.
I have to take it from each one of those. You cannot commingle old employer accounts, and this becomes important because, like we said, maybe there was money sitting in something that I didn't want to have to touch. Well, now I have to. I have to take it out of this one versus that one. And we'll get to in a second why that's another problem. But the idea is that you can't say, well, gee, I took it all from bucket number 1. That's what I was supposed to do. I had this number and I just took it from here. With old employer accounts, you can't do that, and you wind up back at number 1 again, which is I didn't take it.
And taking more money out than you need to by the time you're done, right.
Or I get penalized because I didn't take the proper distribution.
Correct.
You know, in terms of going through that. So it's something to be aware of when we're dealing with this and looking at old employer accounts. Next slide. It's this fun little game for me because I don't remember what the order is. So
now
it's
you know how I feel every day. I never know what we're doing. So mistake number 3, getting caught in the 20% tax trap.
Yes. So here's the thing, as we were just talking about, and why sometimes it may not be the best interest to leave your money at your old employer plan. One, as we just described, that whole thing with the multiple RMDs, suddenly now I can't pool them, I've got to take from it. But the other is any money that gets distributed out of a former retirement account must take, by the Department of Labor, the DOL, and the IRS rules, 20% federal withholding. You go to the next slide where we detail this a little bit, but the idea here is that you can't say, I don't want to have taxes withheld.
Right.
In an IRA, you can. So if your money's in an individual retirement account, you decide how much of a tax withholding you want to put into this thing. Whereas if the money's sitting at your old employer's plan, they have to take it. And more than likely, if you're here, like in the state of Massachusetts, they're going to have to take the state tax withholding as well.
Yeah, now this could be a double-edged sword either way, right? So the first off, let's say you do it out of your own IRA and you take no tax. Well, it doesn't mean you're not going to owe any tax at the end of the year. You could. Now, let's say they take it out mandatory, take out 20%, but you didn't know that much. Well, you're going to get that back. So once again, it's a neither here nor there issue, except for the fact that you want to make sure you're keeping track of what's going on.
Right, but in some cases you may not be getting it all back because you may not be having that tax bite.
Well, it depends on what tax bracket. Then you would have had to pay in anyway. So,
but it's just you put yourself in that situation when it happens, and it's just one of those things that to be aware of.
Right, but the government's not keeping money they're not supposed to keep. That's the only thing I'm trying to make clear.
Oh, okay.
Right? They say, oh, they took 20%. I'm not getting that back.
Oh yeah, no. You have to file, but in some cases you may not have had to file. right?
Well, now maybe you do because you
Yeah.
get money back, right?
Exactly. So it's just these are complications that can occur as you go through with this. So just be aware that that's the situation. Next one. Mistake number 4, not reviewing beneficiaries. This is a big one. This one is probably the most relevant of all of these mistakes. And again, a lot of it really doesn't have anything to do so much for you because at that point you're gone, right? You're no longer with us. But the problem here is there are all sorts of situations that have come up. Craig and I have dealt with this and numerous times where it's something as simple as either, I signed up for the company retirement plan when I was in my 20s and I never changed it.
Yeah, you want to leave a lasting memory, mess up your beneficiaries.
Yeah.
The people trying to figure that out for years.
Yes.
Yes, it's a complete disaster when you don't do this correctly. Yes.
Next slide with that. So the idea here is one of the things that we talk to everybody about is twofold. Updating, making sure that the beneficiaries are up to date, that the information is correct, that it's the person that you want to receive the funds, but that you should also have a contingent or what is known as a backup beneficiary so that primary beneficiary predecease you. If you think of this as a family and maybe you're married, so your spouse is your primary beneficiary and you have children, they would be your contingent or backup beneficiaries. And everybody says, oh yeah, I get that, I think about it.
Right.
But like we just talked about, a lot of times what happens is I signed up and yes, I was married, so I named my spouse, but we didn't have kids at the time. So I didn't put a contingent beneficiary on it. And then I never went back to it. And then there are situations that occur where it wasn't my spouse, it was somebody else. I'm not married.
Right.
But then they died.
Correct. Yeah. And that's the other thing too, is there's more and more mixed families, and a lot of times people may have another relationship later on, but they may not get officially married. Or the other issue could happen is, you do have a spouse, they pass away, and then you don't update the beneficiary after the fact.
Right.
And so you assume it's going to go to your children, but you never put it on the forms, and so now it's got to go through probate.
Right.
Still may end up with your kids, but it's just a whole other process you have to go through. So it's just, like I said in an earlier episode, 2 seconds of planning now can save a whole lot of heartache later.
Right.
Yeah.
And the idea there is just to make sure, and what we recommend is that everybody should take that, let's call it every couple of years. Maybe it's 3-4 years, just to go back in, because all of a sudden we have a lot of stuff, right? It's not just employer retirement accounts or individual retirement accounts. It's life insurance contracts. It's annuity contracts and savings bonds. There's all sorts of things that have beneficiaries attached to them. And it's very, very important that everybody take a moment and go back and say, wait a minute, who's really getting my stuff?
You might not even like them anymore. You may not want to have your stuff.
We had that happen. I had somebody come up to us after we did a presentation on this stuff and said, I have all these people I named. I don't like them anymore. What do I do? So I'm like, okay, I don't know how to answer that, but we'll deal with it. We'll figure it out in terms of going through that. Next slide, please.
There it is.
Mistake number 5. Not understanding how surviving spouses can accept the decedent's IRA, right? So here's the thing, and you can go to the next slide, because this is a little complicated, it's a little bit more involved in the planning aspect of everything, right? So, the idea here is that as a spouse, you have the right that you can, whether this money's in an individual retirement account or at the corporate employer retirement account, leave the money as it is, right? You can actually have it just, I'm taking it over, it's known as a spousal IRA, spousal rollover, to just take it over as is. However, a lot of times what will happen is the custodian, and that's just whoever's holding the money, will say, wait, no, we've got to change this, we've got to retitle it to you. Yes and no. Doesn't necessarily have to, but even if you do, a lot of times what they'll try to call it is a inherited IRA.
Correct. It'll be titled as such.
Yes, entitled as, and it's not an inherited IRA. So the inherited IRA in that situation should be immediately retitled to be in the spouse's name.
Right.
Because here's the thing, a spouse is not held to those required minimum distributions or the force out of money as a non-spousal beneficiary. We don't talk about it too much in this. We get to it at the end a little bit. But the whole idea is if you are the spouse and the money is rolled over to you as a spousal IRA, it's based on your life expectancy, those required minimum distributions. In the case of a non-spouse, and that can be children, that could be anybody.
Partner, yeah.
It's 10 years. The new update, Secure Act 2.0, says you've got to take it out within 10 years. So you never want to have a spousal IRA wind up in a situation where somebody's trying to tell you have to take it out within 10 years.
Unless you're 95 years old.
Okay, but even at that, you could live to, what was the one I just saw? Somebody was like 111 or something.
Oh my God.
So yes, so there's none of that. It's just, you want to be able to take it over your life expectancy, over your lifetime, whatever the case may be for that. Next slide. Mistake number 6. Roths, right? So this is not fully understanding a Roth IRA and how a Roth IRA differs from what we'll call a traditional IRA. So traditional IRA is that pre-tax vehicle. I've taken money, I have put it into the account, I am telling the IRS on my taxes I am taking a tax deduction. A Roth is after tax, right? So Roth IRAs, this becomes a very, very, Craig and I talk about this all the time as a planning tool when we're talking about tax-free income later on in life. Because I'm putting money in, yes, I'm not getting a tax break today, but the money is growing tax-free. Oh, and those required minimum distribution thingy, that doesn't apply. Not part of a Roth.
Yeah. Neither does if you pass away having to take the money out in a certain period of time.
Yeah.
Regardless of the relationship. So it's a little bit easier from passing money from one generation to the next through a Roth vehicle than a traditional IRA.
Right. So a lot of times people get caught up in the whole, am I putting money in, am I not putting money in? And one of the things that we talk to everybody about is this whole balance of, what are you trying to get? Am I trying to get a tax break today? Am I trying to put money away for later? And this trade-off, this balance of the two to say, here's what I've got, here's where I'm at, and I'm trying to take that tax break, but I also want to have a tax-free bucket.
Right. I think the issue too is it's not all or one or all or nothing, right? Because one thing I don't know is 25 years from now, what are the tax laws going to be? Right. They could change Roth tax laws. I have no idea, right? But I know what they are today, and I know having a mix of different vehicles allows me more flexibility when I do get to retirement.
Yes.
So it's good to have, balance in what you're doing.
Right, absolutely. And that's the whole idea with that. And the idea of the Roth is that, again, there's a limitation. Certain people, depending on how much income you make, you may not be able to take advantage of a Roth IRA. But a lot of times, especially in today's world, most employers now have the Roth component inside their retirement plan. We won't get into that. That's a little deeper of a conversation. But anybody can contribute to that. So there's no earnings limit. There's no phase out in terms of who can contribute.
Just a contribution limit, like it would be in a standard IRA.
Correct. All right, last one. What is number 7? This is like a rolling a game here, All right, so the tax breaks, right? So you can just flip into this because this just real quick with this in terms of sort of understanding that, that how we just talked about the whole idea with taxes, right? And what happens, and just understand that a lot of times your IRA, it becomes part of your estate. So not only does it become part of your estate, it's getting taxed at the same time.
Right.
So I'm getting taxed because it's a distribution out. My beneficiaries have to take this money out within 10 years, like we just talked about.
Right.
But it's in my name, so I get it's part of my estate tax.
Yeah, the estate gets taxed before they even get that money to get taxed on again. Right.
So there's just layers upon layers with this in terms of going through it. So sometimes it makes sense to try to get this money out, and that's whether that's through gifting, whether that's charitable donations, other ways of dealing with this.
Spending it and leaving other assets.
Yes, and having other things, because having money left over in this retirement account does create this other tax consequence that is just like not thought about. It's just like, well, wait, I'm going to get taxed and then taxed again.
Yeah, Tom and I do talk a lot about the fact that some vehicles are very good for leaving as a remainder asset and some are not. And you know, when you talk about retirement assets, IRA assets, very good for what they're intended to do, which is help you with retirement. Not great for leaving behind for other people to deal with, only because of all the different tax consequences that come involved with it.
Next one. Yeah, that's the one. See, they don't vote.
They don't vote. Dead don't vote?
Who do you tax?
Well, only sometimes they vote.
All right, so understand that IRAs are a very valuable tool. They absolutely are fundamental for planning, but they can get very complicated. And there's a lot that goes into that, and there's a lot to be thought about with it, so they're very complex. And there are strategies that you need to be thinking about and using when doing these. All right, last slide. All right, so again, a plan is the idea here. Whatever you're trying to plan for, and as Craig said, it's just a few moments, a couple of minutes of conversation can really sort of plot out what makes the most sense. Should I have pre-tax? Should I have post-tax? What should I be doing? How this is going to benefit me?
Right, and the reason you want to do planning too is it's not just about the mistakes you want to avoid, it's also the things that you should be doing right. Right, when to start putting away, how much to be putting away, what do you want your future retirement to look like as far as income goes, how to be as efficient as possible with those income options. And there's just so many dynamics to that you really want to be working with somebody. Don't guess.
Yeah. Next slide, which is really what it's about for us, right? So that QR code on the screen, all we're going to say is if you're watching this on TV, pause the TV, take out your phone, snap the QR code. It's going to open up our scheduler. Schedule a time. That's why we're here. There's no cost. It's complimentary. We're happy to have a conversation with anybody. And really, it's about that idea. What are you trying to achieve? What are you trying to get to? How are you going to make that happen? So reach out to us. Next slide, there's different ways to contact us. You can contact us, again, we said, you can go to the website. That's www.aresfoundation.org/contact. They'll take you right to the contact page, but you can check us out, the rest of the website, all the stuff that we do. The schedule, it's easier if you just back this up, hit pause, and use the QR code, because that'll do the same thing as that scheduler. Email, you can send us an email, info@aresfoundation.org. We're happy to answer emails and questions that come in that way. Or you can follow us on social media. We got a ton of social media channels, Instagram, Facebook, LinkedIn. Like us, follow us, whatever you're supposed to do on those channels. I don't know what you're supposed to do, but take advantage of that. The idea here is we're here as a resource. Reach out to us. Let us know. We're happy to answer questions, happy to give you, as Craig said, just a couple of minutes of having a conversation to sort of plot out and plan out what it is you're trying to accomplish. And on that, we will say, scroll.
Prescription drug pricing points to corporate
Freedom of the press is about your right to know.
and Clark sheer athleticism.
It's about your right to be informed.
For the stock market.
Today, there are real threats to press freedom
Is reaching residential areas.
and your right to know about the world around us. We must protect our right to know, no matter what kind of news is important to you.
Great question.
Before it's too late, understand the threats. ProtectPressFreedom.org.